Hi, my name is Sid Parekh, and I'm here with the introduction. Over the past few decades, we witnessed a dramatic shift in how companies create and capture value. Back in the 90s, intangible assets such as brand reputation, intellectual property, and corporate culture accounted for only 17% of the total asset value in the S&P 500. Fast forward to today, and these intangibles, particularly goodwill, now make up over 90% of that value. This isn't just some small accounting detail. It's a fundamental transformation in how businesses operate and compete. Companies are now betting heavily on the strength of their brand, innovation capabilities, and the loyalties of their employees and customers. But with greater reliance on intangible assets comes greater risk. Intangibles, like goodwill, are incredibly sensitive to issues of reputation, culture, and governance. Today, unmanaged environmental, social, and governance, or ESG, risks can rapidly erode goodwill, undermining shareholder trust and causing significant financial losses. A poorly handled ESG issue, such as controversies over labor practice, governance failure, or environmental negligence, can quickly escalate, leading to write-downs and irreversible reputational damage. That is why it is critical for corporate boards to shift their perspective on ESG, from simply checking boxes to proactively integrating ESG into everyday strategic decisions. This evolving landscape also reshapes how companies approach mergers and acquisitions. The volume of M&A transactions has surged in recent decades, with firms increasingly leveraging acquisitions to accelerate growth, innovation, and market presence. Yet ESG factors can decisively make or break these deals. ESG issues can sabotage deals through stakeholder backlash, cultural clashes, or regulatory interventions. However, this also creates unique opportunities. Companies struggling with ESG can become attractive acquisition targets due to discounted valuations, presenting chances to unlock significant value through improved ESG management. Conversely, organizations with stellar ESG reputations often command higher premiums, sometimes far above their intrinsic value, reflecting how crucial effective ESG management has become to the market. As we delve deeper into today's discussion, we'll explore exactly why ESG must become a board level priority in M&A and how these intangible assets have reshaped valuation strategies, and what practical steps can companies take to harness ESG to protect and enhance shareholder values. Let's get started.
So, why now? ESG used to be a footnote, an afterthought. Now it's front page news with immediate backlash if things go wrong. Back in 2018, ESG was a side task. It lived with PR or legal and it rarely touched deal value. Then everything changed in 2020. COVID exposed how companies treated their people. The George Floyd protests elevated DEI to a global priority, and suddenly ethics, fairness, and leadership were not just moral issues, they were also strategic ones. Fast forward up to 2021 to 2022, we saw Tesla lose ESG index inclusion, Activision get hammered for culture issues, and Uber face internal revolts. And in each case, there was massive media attention, protests, investor exits, and billions lost in market value. By 2023 to 2024, regulators stepped in. The EU, SEC, global exchanges, everyone began enforcing ESG disclosures. Investors like BlackRock and State Street made it clear that if companies didn't have an ESG strategy, they wouldn't receive capital. And now in 2025, ESG is fully embedded. It's built into M&A risk models, and leadership is held directly accountable. When things go wrong, the fallout isn't just reputational, it cancels deals, uh, there are valuation cuts, and there are lawsuits. So, what has changed? Pressure from investors, regulators, and limited partners force ESG to shift. It's not about optics anymore, it's more about financial materiality. Asset owners like Harvard Management now view ESG as part of fiduciary duty. They expect external managers to integrate ESG into the investment strategy itself. At the same time, firms like McKinsey are clear. ESG is real, but the reporting landscape is a mess. There's too many ratings, too many metrics, and what matters is not checking boxes. It's identifying ESG issues that actually drive cash flow, and risk. And it's not just talk. Private equity firms like Pincus are building ESG into every step, from due diligence to board governance to limited partner reporting. They're responding to real pressures from LPs, lenders, and even customers asking for ESG policies before doing business. So the question isn't whether ESG matters, it's more about how to evaluate it in a way that actually supports better decisions, especially in high stakes moments like M&A or leadership transitions, where reputational and cultural risks often go unnoticed until it's too late. And so that's where our project comes in. We're building a toolkit for boards to detect and manage ESG related risks early before they trigger backlash, destroy value, or damage reputation. And to do that, we're using the six capitals model, a framework that my colleague Brett will expand upon in the next slide, and our own valuation toolkit to help boards quantify culture risk, model potential integration costs, and assess the upside of strong ESG performance. So we're turning what used to be soft issues into hard numbers.
We often hear ESG discussed mainly in terms of risk, but it doesn't fully capture the value creation side of the story. That's where the six capitals model comes in. It looks at how an organization creates value across six interconnected types of capital, from financial resources to ecosystems, innovation, and talent. These include financial capital, which is money and investment. Manufactured capital is physical infrastructure. Intellectual capital is data, systems, and innovation. Human capital is people, skills, and well-being. Social or relationship capital is trust and networks. Natural capital is the environment and resources we depend on. Unlike ESG, which evaluates external risks in three categories, six capitals give a 360-degree view of how value is built, including intangibles like knowledge, brand, and employee well-being, while ESG often overlooks. For boards and leadership teams, it enables more integrated long-term decision-making by showing the full range of inputs behind sustainable performance. So this isn't just about being sustainable. It's about understanding what actually drives value in your business. That broader lens helps us see value more clearly, but how does it actually influence business decisions? Let's take one of the most high-stakes scenarios, M&A. ESG, which reflects many of the six capitals, now shapes the entire deal lifecycle, from screening to integration. ESG considerations are enabled across every stage of the M&A process, not just due diligence, as many assume. The first one is target screening. ESG acts as a filter, highlighting future fit targets like clean tech firms and flagging risks like high emissions or weak labor practices. Second one is due diligence. ESG uncovers hidden risks such as environmental liabilities, diversity gaps, or governance red flags that might impact deal terms. The third one is valuation. Strong ESG credentials can drive a green premium, while poor performance can lead to discounts or tougher financing conditions. The last one is integration. ESG supports smoother onboarding, aligning culture, stakeholder expectations, and sustainability priorities between the two firms. So while ESG started as a compliance lens, it's now a strategic lever, helping acquirers manage risks, unlock value, and build more resilient, stakeholder-aligned business.
I'll discuss the better ESG due diligence in M&A. First, we should know that ESG due diligence is crucial in M&A to identify risks that traditional financial analysis might miss. It helps detect potential red flags, such as reputational risk and regulatory compliance. By focusing on ESG factors, companies can make more informed decisions, mitigate risks, and ensure a smoother integration, ultimately leading to better long-term value creation and stakeholder trust. When conducting ESG due diligence, it's essential to identify potential red flags that could signal risk for the deal. These red flags often fall into three main categories. The first is environmental, such as the unreported pollution incidents, non-compliance with environmental regulations. Second is the social, such as the poor labor practices, unsafe working conditions, or negative media coverage related to human rights violations. Third is the governance, the lack of board diversity, independence issues, or history of corruption and unethical business practices. To detect these risks, tools such as PwC ESG risk assessment and FTI consulting ESG due diligence services can be highly effective. Additionally, using the six capitals framework helps in identifying risks across multiple ESG dimensions. There are three significant areas in ESG due diligence. In approaching ESG due diligence within M&A, it is essential to move beyond surface-level reviews and ask deeper, more insightful questions. Our focus must be on understanding how values are enforced, the tone at the top, and the genuine sentiments of employees, customers, and investors. These elements offer a more accurate reflection of the company's commitment to ESG principles and help identify potential integration challenges. There are some key considerations, such as the target's approach to ESG governance, the involvement of the target's board in the development, implementation, and monitoring of ESG strategies, and the ESG factors most relevant to the target's ability to operate its business effectively. Addressing these critical questions ensures a comprehensive evaluation, allowing us to align the target's operations with our strategic objectives. Then, determining which ESG factors are material is fundamental for us to detect red flags. This involves understanding the target industry context and evaluating the broader impact on key stakeholders. Materiality assessment ensures that we focus on the risks and opportunities that are truly significant to the business and its long-term success. There are some key considerations, like identifying ESG risks that are significant to the target stakeholders, understanding how these risks affect the company's ability to meet its business objectives and achieve sustainable growth. If we lack a clear framework to assess materiality of target, we should develop our own materiality assessment using our own rubric. Relevant industry standards, targets reporting criteria, and what we believe to be material to key stakeholders. Material ESG risks must be prioritized during the due diligence process, utilizing recognized reporting frameworks such as SASB and GRI will aid in evaluating this risk and ensure that our analysis is aligned with industry standards and best practices. Then, after we confirm our approach and materiality, we should perform gap analysis. It assesses the current ESG performance of the target company and identifying areas that may expose their acquired to risk. This analysis should encompass not only environmental issues, but also social and governance factors that could influence post-merger integration. There are 4 key steps. First is assessing the target's ESG performance. We should evaluate the target's current ESG status and determine how it could affect the acquirer. Second, we should create an action plan. Develop a detailed action plan to address and mitigate identified ESG risks, including environmental violations, poor labor practices, and governance concerns. Next, integrate ESG considerations into the financial valuation models, taking into account the costs associated with compliance, integration, and stakeholder engagement. Finally, ensure that ESG risks are effectively managed at the board level, either through direct involvement or by establishing an ESG commitment to oversee the risks and progress. By conducting the thorough gap analysis, we can identify and address both immediate risk and long-term challenges, ensuring a smoother and more effective integration post-transactions. Finally, there are 7 best practices we recommend. Conducting ESG due diligence on every transaction. Investors who regularly perform ESG due diligence are more likely to uncover material findings. Linking ESG due diligence approach to overall corporate ESG strategy. Linking ESG due diligence findings to clear post-closing actions. Next, looking beyond risk for the value creation potential. Clearly defining due diligence work streams, securing appropriate resources, and continuously improving. The financial investors, especially in Europe, are leading the charge due to evolving regulatory frameworks like the EU FDR, which are driving a greater focus on sustainability. Next, let's invite Laura to discuss valuation in ESG, which help us to better make dealing decisions as well.
I will be presenting Valuation Toolkit, Pricing ESG. To set the stage, I want to walk you through the current landscape of ESG and M&A. This graphic highlights key findings from the Global ESG Due Diligence Study 2024 by KPMG, which surveyed over 600 active M&A deal makers across 35 regions. The findings highlight that ESG due diligence is rapidly becoming a standard practice in M&A, driven primarily by its direct financial impacts. Most dealmakers reported willingness to pay a premium for targets with high ESG maturity, and over half have encountered ESG-related deal stoppers. A striking example of ESG financial impacts is Uber's sharp valuation decline following the 2017 #DeleteUber campaign, a backlash that erupted when Uber disabled surge pricing during a taxi strike protesting the Trump administration's travel ban, prompting more than 500,000 users to delete their account within days. Combined with broader social and governance shortcomings, Uber suffered a nearly 20% loss in the US market share. As a result, Uber's IPO valuation fell from an anticipated 100 billion to 82 billion, and by the end of 2019, its market value had dropped below 50 billion. In an acquisition scenario, these ESG risks could have justified a lower goodwill balance at purchase or triggered an early impairment if materiality had affected projected cash flows. A similar example is Tesla's sharp decline over the past year. Investors and consumers backlash over governance and social issues, including labor disputes, discrimination allegation, and CEO Elon Musk's controversial political activities, has significantly damaged Tesla's reputation. Since late 2024, the company's stock has lost more than half its value, erasing over 800 billion in market capitalization. The car sales have dropped sharply, and major pension funds and institutional investors have begun divesting. Citing persistent ESG failures and lack of meaningful improvements, as a result, Tesla now ranks near the bottom of the auto industry in key social and governance matrix. Both the Uber and Tesla examples underscores the financial risk of poor ESG performance. However, the inverse is also true. A historical analysis of MSCI ESG ratings across global and developed markets assessed their influence on long-term equity performance. The study found that companies with higher ESG ratings consistently outperformed their lower-rated peers, exhibiting strong stock and bond performance, higher earnings growth, improved profitability, and enhanced dividend yields. These companies also demonstrate greater earnings resilience and lower systematic volatility, suggesting that ESG contributes to more stable financial performance. The results demonstrate that performance was driven by superior financial fundamentals rather than by inflated valuations or short-term market sentiments. This distinction is important as it indicates that ESG integration supports sustainable value creation grounded in core business performance. From an accounting perspective, it's highly significant. It means that ESG maturity is associated with measurable improvements in key financial metrics, such as return on equity, cash flow stability, and cost of capital, which are fundamental to valuation models, financial disclosures, and due diligence processes. In the context of M&A transactions, these insights provide more reliable inputs for financial forecasting, reduce risk of goodwill impairment post-acquisition, and enhance confidence in long-term value creation. Similar results were observed in a study done by Deloitte. They found that companies with higher ESG ratings are valued more highly in equity markets. Deloitte used two main methods of comparing market valuation multiples and running discounted cash flows analysis. Both showed that better ESG scores lead to higher company valuations. Their analysis revealed higher ESG ratings lower the company's cost of equity and debt, which reduce the overall capital WACC and increases valuation. In example scenarios, Deloitte found that 10-point increase in ESG ratings could boost the company's value by 5%. This graphic demonstrates the assertion that the higher ESG ratings drives value creation through multiple channels, reducing systematic risk, the beta, lowering financial costs, both debt and equity, and ultimately increasing enterprise value. Building on Deloitte's methodology, I applied a residual valuation to assess how Palantir Technologies, a company with relatively low ESG scores, might benefit from a hypothetical merger with Salesforce, a leader in ESG performance. Central to this analysis is Deloitte's findings that 10-point increase in ESG could boost a company's value by 5%, a relationship I demonstrate through reducing the systematic risk, the beta, and its direct impact on lowering the cost of equity. This valuation model is based on a discounted cash flow with an explicit 9-year forecast horizon. One of the key components of the valuation is the cost of equity, which was 12.35, derived using a capital asset pricing model with a risk-free rate of 4.4%, market risk premium of 4.65%, and a beta of 1.71%. 1.71 beta. The intrinsic value of Palantir as of December 31st, 2024, was determined to be $96.13 per share. The current market price is 112.26, which indicates the stock is overvalued by 16.8% relative to the calculated intrinsic value. By simulating Palantir's adoption of Salesforce ESG practices, the model quantifies how hypothetical 10-point ESG improvements, all else equal, reduces Palantir's beta from 1.71 to 1.642, reflecting decreased exposure to market risk. This beta reduction lowers Palantir's cost of equity to 12.03% and drives the projected 5% increase in valuation. Looking at the valuation side by side, you can see that the reduction of Palantir's beta by 0.0685, which reflects a lower systematic risk from improved ESG practices, decreases its cost of equity by 0.32% via the capital asset pricing model. This lower discount rate increases equity value by 5%, which translates to an 11.249 billion valuation increase. This aligns with Deloitte's research and demonstrates how even marginal risk reductions driven by ESG maturity can significantly enhance valuations of the company. Another study by MSCI, which employed industry selection and weights of ESG issues rather than treating environmental, social governance factors equally, found that the combined ESG score delivered stronger and more stable performance than individual ES and G components, indicating that added value from aggregating ESG factors. This is particularly relevant in M&A transactions as identifying the most material ESG factors with each industry enables more accurate valuation and reduce the risk of overpaying for companies with inflated ESG reputations but weak financial performance. At the same time, acquiring firms have the opportunity to create value by adopting or exporting strong ESG-related business practices across the combined entity. Estimating the potential cost of ESG improvements alongside quantifying benefits such as reducing beta or improving risk-adjusted returns can help investors better assess full value creation potentials of ESG integration.
Today, I will be speaking about a topic that often goes unnoticed during M&A, but can make or break their success, which is people, risk, and cultural misalignment. While most due diligence focus on financials or legal compliance, those softer factors are often undervalued. But when integration fails, it's rarely just about the numbers. It's about people, it's about culture. Those factors can in fact have very hard financial impact in M&A. In this chart from MSCI that Laura mentioned before, the dark blue line shows a cumulative return greater than 35% in 2023, far outpacing the individual pillows. This may indicate that a firm that fails to engage its employees, which indicates as social and lacks ethical leadership, which is governance, will underperform even if its environmental strategy is strong. ESG pillars must support one another. So how can those pillars be related to M&A? Our team tries to quantify each of them and find their hidden value. Environmental performance has very real and measurable value. Cost savings from energy and waste reduction directly impact operating margins. Revenue growth happens through green innovation and premium pricing. Earnings Q is a ratio that compares a company's market value to the cost of replacing its assets. Study shows strong ESG leads to higher turbines Q by 0.98 to 1.30 points than lower ESG performers. Firms also benefit from financing cost reduction because of lower perceived risk and those green bonds. Finally, being proactive on emissions and sustainability can unlock subsidies and protect strategic flexibility, also reduce regulatory risk. Now we turn to the S&G pillars, often the hardest to quantify, but absolutely essential. In M&A, cultural misalignment and people risk can silently destroy value, so we created a model to quantify it using the formula adjusted value equal to base valuation minus cultural discount plus cultural upside and minus integration cost. On the left side, you see cultural discount. The right side is cultural upside. And we choose 4 elements for each of them. Those factors can vary from company to company, but here our team has selected those key factors that we believe have the most significant impact on cultural value. So on the discount side, we gave turnover of 35% because the cost of losing people, especially key leaders or like technical talent, are immediate and significant. Replacement is expensive and time consuming, and also it's very risky. That's why high turnover will drag down valuation quickly during integration. Well, if we lose those low performers or people who do not align with the culture, it may go to culture upside. On the culture upside, retaining talent only contributes 20% because we think retaining talent is a defensive move. It prevents loss, but it doesn't directly grow value. In other words, not losing people is good, but not as impactful as unlocking higher performance. So then let's look at productivity. In the discount scenario, disengaged or confused employees slow things down. That's why we assign 30% to lost productivity. But when culture aligns and people are motivated, productivity can be transformational. It's a level to grow value, so we gave it 45% weight on the upside. It can increase output without increasing employees, which is, increase value directly. To make this even more actionable, we calculated a culture ROI, which means if we spend 1 million on cultural alignment, what's the return? And the integration cost can be retention bonus to keep talent, training activities, and the cost of hiring experts. That's especially helpful when advocating for integration budgets after M&A activity. Okay, to conclude, people risk and cultural misalignment are no longer intangible concerns. When we quantify it, measure it, and align it with business strategy, it becomes one of the most powerful levers to drive valuation in any M&A deal.
Hi, I'm Tongyan Zhang, and this is the segment I will walk you through the crisis management when ESG backfires. It is a practical playbook for boards to follow when ESG risks erupt into full-blown crisis. And now let's recognize the early signs of ESG fallout. Well, the moment a serious ESG issue begins, you will see three parallel alarms. The first one is these external warning signs often foreshadows bigger problems. For example, Nike's brand took a hit when the bad press and boycotts over labor practices eroded consumer trust and investor confidence. The board should treat sustained negative headlines or trending criticism as a fire alarm and not the background noise. And the next, disgruntled employees often voice issues internally long before they explode publicly. Uber's crisis began with a whistleblower blog about the persuasive harassment. An early warning the board needed to act on, and a proactive board creates channels to surface these concerns and addresses them before they become front-page news. And the last one, investors are increasingly vocal on ESG matters. If major shareholders starts flagging your company, like downgrading its ESG scores or demanding leadership changes, it is a clear sign of trouble. Pay attention to pointed ESG questions on earning calls, shareholders' proposal on sustainability, or threats of divestment. And if you're a large institution, investor starts flagging your ESG disclosures or demanding leadership changes, just treat it as a red flag, not the background noise. Well, the next step is to act quickly. Time is your greatest asset and your greatest risks. When ESG fallout begins, acting decisively undercuts rumors, builds stakeholder trust, and frames the stories on your own terms. Well, the first is when in an ESG crisis, silence or vague PR speak can be deadly. The board should ensure the company prompts puts forth a transparent narrative. What happened, what's been done to frame the conversation. And this might include issuing a public statements from the board or chair and designating a confidence spokesperson. By getting ahead of the stories, you build trust and prevent misinformation from the filling void. And the next is the leadership alignments is very critical. The CEO, executive teams, and boards must be on the same page about the crisis game plan. Discord at the top can paralyze the response. Well, as seen at Uber cases, where boards fighting over how to handle 2017 scandals and bad attempts to address underlying issues. The board's chair should have emergency meetings and daily if it is needed, and coordinate the speak with one voice. Any disagreement stays behind the closed doors, and in public, it is one unified message and the mission. Well, the last one is when in a credibility crisis, outside validation can be game changing. Well, engaging third party experts, be it a former judge to review harassment claims or an environmental auditor after a spill, shows the board is seriously about fixing issues and not just papering them over. And such partners provides an unbiased view and recommendations, boosting stakeholder confidence. As one PR strategy guide notes, the collaborating with independent experts and trusted voice reinforces transparency and commitment to change. And the board should authorize management to retain its experts at the first sign that internal trust is broken. Well, in the ESG emergency, the boards must move from oversight to active leadership. Well, a crisis is the ultimate task of governance, and the board's duty to protect the company's long-term interests means stepping up in the extraordinary ways. And this may involve daily crisis meeting and forming a special committee to tackle this issue, and or even having board members assume the executive roles if the senior management is unable to lead. And this message to organization is that the highest leadership um, is fully engaged in solving this problem. And for example, boards have installed one of their own interim CEO emergency to stabilize the ship. And such actions underscore that the board is not just monitoring the situation, it is leading and the charge to fix it. And also, when ESG issue explode, stakeholders wanted to see accountabilities at the very top. It is power when, say, the board chair issues a forthright apology or outlines a remediation plan alongside the CEO. Likewise, directors should engage key stakeholders proactively. For instance, briefly major investors or regulators on what the board is doing to right the wrongs. And such action shows that the companies isn't just relying on management words, and the board itself is watching and guiding the recovery. By taking ownership, the board helps reclaim control of the narrative and signals that governance is firmly in place. In sum, during ESG crisis, the board's role transforms from oversight to hands-on leadership. It's ensuring the company not only responds swiftly, but also aligns that The response with a score values the stakeholders' expectations and from the top down.
Hi guys, I'm back to finish up the presentation. As we've discussed today, the M&A landscape has dramatically shifted towards intangible assets. Over 90% of the value in leading companies now lies in these intangibles, assets like goodwill, brand reputation, and corporate culture. However, these intangible assets carry heightened vulnerabilities. ESG factors, once seen as a secondary or purely compliance-driven, now have the power to directly influence financial outcomes, shareholder trust, and long-term company performance. Boards of directors must recognize ESG as central and strategic, embedding it deeply within their corporate decision-making process to safeguard and enhance deal value. So what do we do from here? To effectively manage ESG and seize ESG-driven opportunities in mergers and acquisitions, we recommend a structured six-step approach. First, early integration. But begin by embedding ESG criteria into target screening and due diligence processes. Robust due diligence. Use comprehensive ESG analytic tools to uncover hidden risks and avoid unpleasant surprises post-acquisition. Quantifying ESG risks. Explicitly incorporate ESG findings into valuations to better gauge true acquisition costs and potential goodwill impairments. Maintaining values post-merger. Actively manage ESG issues during integration by fostering cultural alignment, clear leadership communications, and sustained stakeholder engagement. Real-time ESG monitoring. Continuously track internal and external ESG signs to respond swiftly and proactively to emerging issues. Top-down leadership in crisis. Ensure board-level readiness to actively lead during crisis, emphasizing transparency, rapid responses, and stakeholder trust building. In closing, ESG is not merely a compliance checkbox or a passing trend. It is now foundational to effective corporate strategy, especially within M&A. Proactive ESG management doesn't just protect goodwill and market value. It also opens doors to strategic acquisitions at discounted valuations. Conversely, companies demonstrating strong ESG performances often command higher market premiums, showing ESG's tangible financial value. Ultimately, businesses that embrace ESG as an integral part to their operations will position themselves not just for sustainability, but for lasting competitive advantage and growth. Thank you.